Ally Financial sent bank shares sharply lower yesterday when it said that unemployment has shown up in its loan book. The bank's CFO told an industry conference that, quote, our challenges have intensified during this latest quarter, leading its shares to plunge by about 20% at one point. That's because everyone knows the evidence has turned decisively against the economic situation. This is very likely why, in my view, Warren Buffett has been continuously selling down his gargantuan holdings of Bank of America stock. That continued again today, and while Buffett has remained silent on the matter, you don't need to be a stock market legend to see where this is going. Recession can be, and often is, a game changer. Delinquencies have already been on the rise along with the unemployment rate over the past year. Now both are threatening to jump together, and investors can feel that tension. For many, their last hope and holdout is, oh boy, the Fed's rate cuts. This is one key reason why market rates have dropped as much as they have. Jay Powell is nobody's last line of defense except maybe Congress and the government. The economy, the banking system, the financial system, that's all up in the air, which is why there are new bank rules being written and argued over, and I'll give you a brief synopsis and update about what that's all about. Nothing positive and reassuring, I assure you. Recession and unemployment are also bad news for commercial real estate. Remember that one? I've got an update there too. Bank stocks as a group had been soaring in July, especially after the June CPI report came out, which sent market interest rates sharply lower. Lower rates are thought to be good for stocks and bank shares most of all. But then in late July, just before the chaos of early August, suddenly bank shareholders seem to have had a second thought about why rates were going lower and what that might mean for their bank holdings. Bank stocks aren't exactly crashing here, but sharply lower, even plunging interest rates is failing to catalyze any buying. And what Ally Financial CFO said is just scratching the surface about why that is. In fact, it's not just Ally. There are concerns growing all over the industry that with the economic cycle turning, so too will the credit cycle. Here's what Bloomberg reported just yesterday. U.S. banks scored a big break from regulators on new capital rules, only to ruin their own celebration with downbeat outlooks on lending. Fears that a Goldilocks era of healthy borrowers and fattened loan margins is ending swept onto the market stage Tuesday as financial stocks tumbled. It made for a jarring split screen, with the Federal Reserve dialing down proposals for how much capital banks will have to hold against certain assets, just as banks signal that the performance of some assets is set to worsen. Their statements will likely stoke debates about whether the industry will experience a soft landing as interest rates tick down, and whether proposed rules are tough enough for worst-case scenarios over the longer term. And this is something they've been calling Basel endgame. And just to give you a brief synopsis of what this is about, basically after last year's banking crisis, regulators realized they have no idea what banks are doing. Capital ratios, which were invented a very long time and completely failed to do much of anything in the first crisis in 2008, those were supplemented by liquidity coverage ratios, which were exposed as, again, worthless in last year's banking crisis because Credit Suisse, most of all, the complicated global dealer bank that it is, had ample liquidity coverage according to that ratio, was well capitalized, and it failed anyway. So regulators, very briefly here, and this is a complicated topic and one I've gone over repeatedly at our deep dive analysis because we really need to take a deep look at it. But the overview is simply bank regulators around the world don't know how to regulate these complex banks because they're not really banks. They're bookkeepers who get into a lot of different things that we talk about at Eurodollar University. So their solution to try to get a handle on what banks are doing is to have them hold a massive amount of capital so that they're basically protected, at least according to these counter rules, against every possible scenario under the sun. It's basically like taking banks and bubble wrapping them and never letting them out of that bubble. Banks had pushed back against the Basel rules as they were originally written, these new proposed rules, and the win that the media was talking about is that regulators got together and decided that the new rules were indeed too onerous. In fact, it was estimated that it would require banks to raise about a third more capital, and so they watered down the rules a little bit, maybe to around 9%. Those are the estimates I've seen. So banks had convinced regulators that they were being way too harsh, only to now suffer the initial stage of what looks to be a credit cycle change which could reignite the debate all over again. Basel endgame isn't completely done yet. But again, it doesn't actually matter because regulators have no idea what banks are doing. Banks are doing what they're doing anyway. And a lot of what they were doing was based on the idea of a soft landing that's now increasingly out the window. But no one ever asked the really tough questions about all of this, starting with, well, what good are bank reserves? If you have trillions of these bank reserves and we still have to worry about banks and we have to quote unquote toughen rules to the point that we're basically bubble wrapping bank institutions. And by the way, these are questions that we've already answered at Eurodollar University in our memberships. We talk about what is QE, what is QT, what is money, what are bank reserves for? That's what Eurodollar University memberships bring to the table. So over at Barclays' 22nd Annual Global Financial Services Conference, Ally Chief Financial Officer Russ Hutchinson had some comments which had the entire marketplace and financial media talking for good reason. Now, it sent the company stock, Ally stock, down 20%. At one point, I think it finished about 16% down, which is an enormous move for such a large financial firm because of what he said. And he was quoted as saying, over the course of the quarter, our credit challenges have intensified. Our borrower is struggling with high inflation and cost of living. No surprise that we've been dealing with that for quite a long time. But then he added, and now, more recently, a weakening employment picture. So delinquencies had already been on the rise up until now. And here's Ally, a leading, especially auto loan lender, saying, yeah, now our borrowers are struggling with not just high cost of living as they have before. Now we're seeing the effects of unemployment. And remember, he's saying that during this most recent quarter, the unemployment problem hasn't really gotten out of control. It's just beginning to become a more noticeable issue. Even the mainstream is now paying attention to it. In other words, if they're already seeing this type of deterioration, which was well above what Ally Financial's models was expecting, then as unemployment continues to be a bigger problem as we go forward, that explains the big reaction in the stock market, as well as what's going on in all the other markets, including commodities like energy, as well as the unwinding, the rapid and serious unwinding on the Treasury curve. Hutchinson even added, as that pool of struggling borrowers in those later stage delinquency buckets has grown, it gives us pause. And as I said, it gives the markets pause, tremendous pause too, because this is not just about Ally. This is not just a one bank issue. This is a systemic problem that's related to the macro environment that is no longer on a path to a soft landing. It's a huge wake-up call for a lot of people, including those running these banks. Now, previously, the Federal Reserve Bank of New York, in its regular household debt and credit report, in the update for the second quarter of this year, they had shown already, especially auto loans, because that's the one that keeps coming up, but also credit card delinquency rates too. But for auto loans specifically, FRBNY's data showed that over the last year, approximately 9.1% of credit card balances and 8% of auto loan balances transitioned into delinquency. Those are large numbers. According to their newly delinquent category, 7.95% of those newly delinquent loans, which was the highest since the fourth quarter of 2010, were 30 days behind. And then the seriously delinquent category, which are those loans which are more than 90 days, 90 plus days behind, that reached a total of 2.88%, which was the highest since the first quarter of 2010 and about the same as the second quarter of 2008. So that was a sharp recession signal, a downgrade in the quality of credit performance back at the second quarter. And remember, Hutchinson just said the deterioration is in the latest quarter. They're just now seeing the effects of unemployment recently. So the Fed's data up into the second quarter of this year is going to be getting even worse into the third quarter, especially as unemployment continues to rise, incomes continue to suffer, and consumers and borrowers and auto loans and everything else in the credit environment and the credit system are going to suffer the consequences of the macro shock. And even before we got to Ally, the day before, on Monday, Bloomberg reported that Citigroup had comments on credit performance as well. Credit losses are rising as U.S. consumers shift spending to basic needs and away from purchases that aren't vital. And that's according to Citigroup Inc.'s Chief Financial Officer, another CFO, Mark Mason. The nature of spending is evolving, Mason said at a conference hosted by Barclays, same conference as Ally. It's going from discretionary to a more staple type spend. Net credit losses have climbed in Citi's large cards business, and payment rates have started to, quote, come down a bit, he said, adding that it's within ranges previously discussed by the firm. So as far as Citi goes, they were anticipating a rise in a deterioration in credit performance, but we still haven't seen the full weight of the turn in the economy either. That's what's got everyone so nervous about this potential, not just recession scenario, but how that's going to play out for banks. That are they really prepared for something like this? Because they've been heavily into soft landing, the artificiality of the supply shock, and everything else. And then the Basel rules come in, the Basel endgame, simply to just cloud everything up even more. All of this is most likely why Warren Buffett has, quite conspicuously, because he's forced to report it, sold down his huge pile of Bank of America shares. It's been the talk of financial media ever since it happened around the middle part of July, right before everything went down in early August. The credit cycle was already starting to change. As the economic cycle, there's tons of evidence that was changing back before all this too. You put these two things together and it makes perfect sense. You don't want to own banks heading into a recession. And Mr. Hutchinson's comments, the CFO of Ally, are exactly why. They think everything is manageable at the start, but if the credit cycle is just now beginning to turn, as the economic cycle is just now beginning to turn, where do things go from here? They don't get better, and certainly Federal Reserve rate cuts aren't going to help. The CEO of Bank of America, Brian Moynihan, was actually asked about Warren Buffett's stock sales at this same Barclays conference. And according to CNBC, he said, "I don't know what exactly he's doing because, frankly, we can't ask him and we wouldn't ask him. But on the other hand, the market's absorbing the stock. We're buying a portion of the stock, and so life will go on." Bank stocks certainly aren't crashing, neither is Bank of America's, but they aren't rising either, even as interest rates go further and further downward, which is supposed to be good for stocks as a whole, and bank stocks most of all. If we look at the NASDAQ Bank Stock Index, for example, what you see is that, just as I said at the introduction, bank stocks had been doing really well June into July, especially July after the CPI came out, when interest rates originally started to go lower. The idea was very simple: lower interest rates, lower funding costs for banks, higher net interest margins. And then suddenly around the end of July, just before everything started going, Warren Buffett's already selling his Bank of America shares, the yen carry trade, liquidations, all of that stuff, recession fears. Suddenly, bank stocks are sideways to lower, even as interest rates go much lower. So the exact reason why Warren Buffett is selling his Bank of America shares, only he knows, and anybody else who works with it, Berkshire Hathaway. But again, it doesn't take a stock market guru or legend to really figure out what's happening here. Getting ahead of the economic cycle, because it's going to lead to the credit cycle that we're already seeing playing out even at these early stages. And of course, that leads us to one other macro-sensitive part of credit and lending and assets and bubbles and everything else. That's commercial real estate. Commercial real estate has gone almost completely silent. Extended and Pretend had it very quiet last year until the early part of this year, but now it's gone completely under the radar for, understandable reasons, given the fact that everybody's focused on the economy, unemployment, everything else. But commercial real estate hasn't gone away. It certainly hasn't been magically fixed. If anything, banks are very quietly disposing of what assets and loans and exposure that they possibly can. But there's all sorts of indications just underneath the surface that are difficult to find, suggesting that they can't even do that much. There was a report earlier last month from Bloomberg about what Deutsche Bank was up to in commercial real estate. Deutsche Bank AG is trying to offload up to $1 billion in U.S. commercial property loans off its balance sheet, just as rising interest rates have dented profits in its real estate portfolio. That's not really a problem, according to people familiar with the matter. The Frankfurt-based bank is marketing the loan book to, this is the key, unlock some capital relief, said one of the people who asked not to be identified because the details aren't public. Unlock some capital relief. That means balance sheet constraints that are being caused by commercial real estate, likely as the modeled values of these loans or whatever exposure it happens to be continues to go lower, which means they're forcing the bank to hold more capital against it, threatening to potentially shift the risk weighting of the assets involved, if they're loans, if they're actually some other kind of collateralized arrangement, any number of potential things. But the bank wants to get out of this before everything really goes down. And they're not the only one. It's not just Deutsche Bank. We've seen in, for example, the Federal Reserve's H8 statistics on the aggregate balance sheets of commercial banks in the United States. Banks want to get out, but they're having trouble disposing of these assets. According to the H8 statistics, total CRE loans are down about $10.1 billion since around May 8th, the week of May 8th. So that checks with the turn in the economy and everything else. And just $10 billion, again, that's not a big number, but they would like to do more if they possibly could. And the biggest hit so far has been in construction and land development, which makes a lot of sense given what construction and land development would be about. And again, this is commercial real estate, not residential real estate. That's where banks have focused their attempts to extricate themselves from the industry and from this part of the asset markets. We see also a decline in office properties, which is called non-farm, non-residential loans. So banks are still getting out as much as they possibly can. It's just that, as this report on Deutsche Bank has said, they're not really able to do it, at least not at the prices and rates that would allow them to avoid taking major hits to everything on their loans and everything on their books. So commercial real estate, which is highly macro sensitive, it sounds like it has actually been locked down even more because of it. As little as what was happening beforehand, there's even less of it happening now. So the second phase of the commercial real estate bust is ongoing, and the less that actually gets done in it, the more likely they get into the third stage, and the more likely that third stage is going to be messy, and the more likely it's going to be messy in that third stage as the economy turns toward higher rates of unemployment and recession. There is nothing that was surprising or very complicated about this. Recession is bad for credit cycles. That's the way it always is. And what Ally Financial said was basically, as bad as the credit cycle had been up to this point, it's been deteriorating slowly but steadily up until now. Suddenly, things have accelerated. At the same time, the jobs market has softened and weakened, unemployment's rising, and everything else. Again, no surprise here. And Ally Financial is not some isolated case. We see dribs and drabs of information from all over the banking sector, all over the economy, as we're still in the early stages of the economic cycle becoming full-blown contraction. People who have been just ignoring all the warning signs in favor of the soft landing narrative are suddenly now paying close attention and being forced to pay close attention, while they also hold out one last hope that the Federal Reserve will be able to save everyone, when history conclusively shows the Federal Reserve and its rate cuts never save anyone at any time or anywhere. This is why J. Powell at Jackson Hole spent so much of his time trying to sell you on rate cuts. Steve and I talked about that in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.